Position sizing. Successful trading involves a lot more than just having a good trading strategy. One critical factor that traders often overlook is the size of their positions. Position sizing refers to the amount of money that you invest in a particular trade. Trading with the right position size can help you manage risk, reduce losses, and increase profits. Understanding position sizing is important because it helps you determine the amount of risk you're willing to take on in your trades. It also helps you to manage your emotions and avoid making impulsive decisions that could lead to significant losses. Here are some factors to consider when determining your position size. Account balance. Your account balance is an essential factor to consider when determining your position size. It represents the total amount of money you have available for trading. The amount of money you invest in each trade should be based on your account balance. For example, if you have an account balance of $10,000, you should not invest more than 2 to 3% of your account balance on any single trade. This means that the maximum amount of money you should invest in any single trade is between $200 and $300. Define your risk tolerance. Before you start trading, you need to define your risk tolerance. Your risk tolerance is the amount of risk you're willing to take on in your trading. This will help you determine the size of your positions. If you have a high risk tolerance, you can invest more money in a trade, which means a larger position size. On the other hand, if you have a low risk tolerance, you'll want to invest less money, which means a smaller position size. Your risk tolerance can depend on several factors, such as your financial situation, investment goals, and trading experience. If you're a beginner trader, you'll want to start with smaller position sizes until you gain more experience and confidence. Determine your position size. Once you've defined your risk tolerance, you can determine your position size. There are several factors to consider when determining your position size, such as your account balance, risk tolerance, and the amount of capital you want to invest. There are several position sizing strategies you can use, such as fixed dollar risk, percentage risk, and volatility-based position sizing. Fixed dollar risk is when you risk a specific dollar amount on each trade. Percentage risk is when you risk a percentage of your account balance on each trade. Volatility-based position sizing is when you adjust your position size based on the volatility of the market. For example, if you're using a fixed dollar risk strategy and you have an account balance of $10,000, and you're willing to risk 1% of your account on each trade, your position size would be $100. Use stop-loss orders. Stop-loss orders are essential when trading with size positions. A stop-loss order is an order to sell a security when it reaches a specific price. This helps you manage risk and limit your losses. When you enter a trade, you should always place a stop-loss order. For example, if you're buying a stock at $50, you might set a stop-loss order at $45. This means that if the stock price drops to $45, your shares will be sold automatically. This helps you limit your losses and manage risk. Monitor your positions. Once you've entered a trade, you need to monitor your positions closely. This means keeping an eye on the market and the price of the security you're trading. You should also be aware of any news or events that could impact the market. If the market moves against you, you'll want to be prepared to adjust your position size or exit the trade. For example, if the price of the security you're trading drops significantly, you may want to cut your losses and exit the trade. Adjust your position size. Adjusting your position size is essential when trading with size positions. As the market moves, you may need to adjust your position size to manage risk and limit your losses. For example, if the market is volatile and the price of the security you're trading is fluctuating rapidly, you may want to reduce your position size to manage risk. On the other hand, if the market is stable, and the price of the security is rising steadily, you may want to increase your position size to increase your profits. Volatility. Volatility refers to the degree of price movement in a particular market or security. The more volatile the market or security, the larger your position size should be. This is because more volatile markets or securities have the potential to move significantly in either direction, which can lead to greater profits or losses. To determine the appropriate position size for a particular market or security, you should consider the historical volatility of the asset. This can help you to determine the potential range of price movements and the appropriate position size. Conclusion. Trading with the right position size can help you manage risk, reduce losses, and increase profits. Adjusting your position size is essential when trading with size positions as the market can move in unpredictable ways. Position sizes is a way to hedge against market conditions and high levels of uncertainty or volatility. Position sizing plays a key role in managing your risk and can be an advantage of potential losses. Use code BLOG to receive 25% on your next purchase.